Okay, this is Wayne Blau, and today we're going to talk about what you must know as a business owner about your balance sheet. Look, I deal with small business owners all the time. Start talking about they need to be able to read their balance sheet and their income statement and their financial statements, and 99% of the, well, all right, 99.9% of their eyes glaze over and they're like crazy. Crazy Bill Al's at it again. That's why I hire you. What they don't understand is very simple. All right, the most successful businesses understand simply that accounting is the language of business, and there's so much data to be mined out of there. And I don't mind if you don't learn because you're going to hire me and other CPAs to teach you, and we love taking your money. So, anyways, I'm just joking on that. So, this is a series that we're doing, and we talked about the importance of it. Now we're kind of going on into what you must know about your balance sheet. Excuse me, sorry. Simply put, a balance sheet is, or statement of financial condition. It's been called all kinds of things depending on what That's accounting. We're not going to get into it. Is basically a snapshot at a particular point in time of the business's assets, liabilities, and owner's equity. And we're going to go into that in some detail. Okay, an asset is anything the business owns that has monetary value. A liability is any claim on future assets. In other words, things you're going to have to pay in the future. All right. And the equity basically is the book value of what the business is worth. It has nothing to do with what the business is really worth. But bankers, if you're going for loans, and the IRS seem to really care about it. So even though the book value really doesn't mean a hell of a lot to anybody that's going to buy your business, because at the end of the day, your business is worth what somebody's willing to cut a check to you for. But you need to understand the basics. We're not trying to make you an expert. So, yeah, let's look at this. Okay, balance sheets along with income statements are really the two basic elements in providing financial reporting to bankers, investors, and vendors who are considering giving you credit. They look at this, and that's why it needs to be important to you. Assets are divided into different categories. We have current assets, which are those assets that are likely to be turned are cash, like this, $105,000 in cash. In this particular, we're using old Larry's Landscaping again as our sample company. It's in QuickBooks. Or assets that are going to be turned into cash, expected to be turned into cash in the next year. Accounts receivable are what customers owe you. All right. So we're expecting to collect our accounts receivable. Prepaid insurance is another fancy terminology. It basically means these are insurance that we've already paid that will be expensed as we use the insurance. And we're not going to spend a lot of time going into that. That's accounting. Employee advances, they're going to pay you back. And inventory at some point is going to be sold, turned into receivables, which is then turned into cash, which those three accounts are worth looking at. There's cash, there's receivables, there's inventory. It's traditional. Accountants put it cash first and the things that are closest to being turned into cash. Inventory first has to be sold, which turns it into a receivable, which then has to be collected, which turns it into cash. And that's why it's in that order. All right. Now that's our total current assets. Now, after that, we have fixed assets, which are equipment. And in this case, it's not a big, all I got is a truck, so we can click here, see the truck, and, go back and see it if we want to. We're not going to waste a lot of time on this. Depreciation is a concept in accounting where the idea is that the cost of that truck is going to be allocated to the income it produces. So we're going to assume, let's say that truck has a 5-year life. We estimate that we're going to use this truck for 5 years. If it costs us $13,000, we're going to take 1/5 of it and write it off as depreciation every year. Accumulated depreciation is exactly that. It's an accumulation of the depreciation deductions that we took over those 5 years. At the end of the 5 years, accumulated depreciation would equal the cost, which $13,750, and this net amount would be zero. Now we can have other assets also. In this particular case, those are things that that just don't turn into cash readily. All right, these could be investments. I've worked with businesses that have stocks and bonds, and they're not easy, or money market or mutual funds, excuse me, that are not turned into cash easily. And then that's a key number. Banks are looking for your total assets and they're looking for your current assets. To that, they compare your current liabilities. Current liabilities are those liabilities that are expected to be required to be paid in the next 12 months. So banks really, this guy they love. I mean, he's got $148,000 in current assets and $9,000. So, $9,400. So he's got like a 14 to 1, almost a 15 to 1 ratio of current assets to current liabilities. Banks love that. If you've got a 1 to 1 or a negative, they hate that. I mean, that basically means that you're not expected to collect. You don't have enough assets online that are expected to turn into cash in the next year to cover liabilities over the next year. And these are again, they're from kind of, in this particular case, separated into categories, but they really don't have the same effect. They could be due at any time. Accounts payable is usually the liabilities that are going to your vendors, your normal expenses that haven't been paid yet, and you can click on that and see that. We'll talk about payables later. Credit cards, these are your gas card and whatever else they have. These guys have a couple of credit cards. Current taxes are usually done. I'm not quite sure what this one is. That looks like an error that we'd have to get into and fix. But you usually have your payroll taxes, your sales taxes, real estate taxes. Those are usually under a category called taxes payable. And then you got your long-term loans. And these are, what that means is just a loan that's got a life of longer than a year. All right. And this is where you keep the value. This is how much you owe on these loans. So this is kind of handy. Now, from that, I have total assets of $160,000. The way the accountants look at that is those assets were 40,000 or 39,297,000 were funded by creditors, and equity of 121,000 was funded by the owner. I'm not sure what this opening balance equity was. Probably the cash that was stuck in at the very beginning in the equipment. This is the draws of what the owner took out of the business that was not deductible. Bankers look at this number here because they really want to know what how much you're draining the business. I mean, in this particular case, the owner's taking very little out. Then we get to retained earnings and net income, which are really the same thing. Net income is simple. That's the amount that's on the balance sheet. On the income statement of how much money you made after expenses. Sales minus cost of sales minus all overhead and other expenses, and then you get net income. So of that, how much was left in the business? And that's what retained earnings is. And in this particular case, they either had losses in prior years or they didn't keep very much in the business. This is kind of important. This needs to be a positive if you really want to get a bank loan, because now I got a little bit of a sales job. I got to explain why we're draining the business by $40,000 in prior years. So that's not good. That's a problem. So as you can see, there's a lot of stuff on here. It's for business owners, the balance sheet tends to be ignored. They pay much more attention to the income statement. But I guarantee you, your bankers, your vendors, and your credit investors are going to pay attention to this as much, if sometimes not more, than your income statement. Next month, we'll talk about the income statement and the key components of it. But for now, this is Wayne Bilal, and I hope this helps you understand your balance sheet of your business a little bit better. Until next time, let's make this our most profitable year ever. Thank you very much.